Hello, everyone, and thank you for attending today's webinar on the 2023 M&A and Financing Outlook, Managing Risks and Finding Opportunities. Before I make introductions and get into the presentation, I'd like to quickly cover some housekeeping items. Firstly, this webinar is being broadcast live. We suggest you enlarge your media player to full screen when viewing the presentation. We intend for this to be an interactive discussion, so as such, we encourage you to submit questions throughout the presentation. You can submit questions electronically through the webcast console Q&A widget. If we don't have a chance to answer your questions, we will make sure to follow up with you directly after the presentation. Lastly, a recording of today's webinar will be posted to our website over the next few days. So with that, I will start with some of the introductions. I'll start with myself. I'm Karan Kapoor, Managing Director in Kroll's Corporate Finance Division and co-head of Kroll's Tech Investment Banking practice. I'm focused on advising middle market technology companies on mergers and acquisitions and raising capital. Just quickly about Kroll, formerly known as Duff & Phelps. Kroll is a leading global provider of risk and financial advisory solutions focused on helping clients build, protect, and maximize value. Duff & Phelps acquired Kroll in 2018 and changed its name from Duff & Phelps to Kroll in 2020. And Kroll's service lines include corporate finance, valuation advisory, governance and risk advisory, and cyber risk. Kroll has a nearly 100-year history and a global team of more than 6,000 professionals across more than 30 countries. I'm going to introduce the panel now. I'm joined by a distinguished panel of experts who I'll introduce now. First and foremost, my colleague, Carla Nunes. Carla is a managing director in Kroll's Office of Professional Practice and a Kroll Institute Fellow. Carla is a leading expert on valuation and an author on numerous cost of capital publications. Carla is also the global leader of Kroll's Valuation Digital Solutions Group, which produces cost of capital related thought leadership. Next, I'd like to introduce Jeremy Swan. Jeremy is the managing principal at CohnReznick, where he leads the financial services industry practice. Jeremy also manages the relationships for CohnReznick with many of its largest private equity clients and their portfolio companies. For those of you that don't know CohnReznick is a leading accounting firm. CohnReznick offers accounting and insurance, tax advisory, managed services and outsourced accounting, and other accounting advisory services. CohnReznick is headquartered in New York and has 4,000 team members across 29 locations. Last but not least, I'd like to introduce Doug. Doug Schnell is a partner in Wilson Sonsini's corporate practice. Doug serves as legal counsel for acquirers and targets in mergers and acquisitions and other corporate transactions. He's a leader of Wilson Sonsini's shareholder activism practice and represents clients in shareholder activism matters, proxy solicitations, and other contests for corporate control. And for those of you that don't know Wilson Sonsini is a premier law firm and a leading provider of legal services to technology and life science firms. For more than 6 decades, the firm has maintained an active role in Silicon Valley as a legal advisor to some of the largest tech companies, but also thousands of the smallest growth stage companies, as well as the VC and PE firms who finance them. With more than 1,000 attorneys worldwide, the firm provides a comprehensive range of legal services. So with those introductions out of the way, let's get started. Today we're going to discuss a range of topics from macro market environments to the impact it's having on valuations, to M&A deal dynamics and opportunities for investors. So maybe to start with the macro environment and the market backdrop, as we all know, the market environment's been choppy. Over the past 12 months, the Fed has raised rates substantially with the goal of stemming inflation. And so inflation had gotten to 40-year highs. And while the rate hikes have seemingly helped control inflation, the significant ramp in interest rates has sent jitters through the economy. The banking crisis being the most recent example of the negative fallout from these higher interest rates. So with that backdrop, maybe my first question to Carla. Carla, since you work closely with Kroll's chief economist, Megan Green. Can you share Kroll's perspective on future rate hikes and maybe relative to market expectations?
Sure. Thank you, Karan, and thank you for everyone who's joining us today. So the big question, of course, is how much the Fed, the U.S. central bank, will continue to raise rates, and when will it stop and then reverse its trend? And all of it hinges upon whether inflation is tamed or not, and whether we're getting into a recession. So currently, like Megan thinks that there would be another increase of 25 basis points at the May meeting, and it will stay like that, or there could be even an additional rate rise after that. When we look at what markets have been saying, and you can look at it, for example, through futures trading. So the CME Fed Watch tool tells you like the market sentiment at every moment, right, when markets are open. And it's been very volatile. So just, a week and a half ago, they thought there was a 50-50 chance that there was no rate rise in May. After inflation came out for March, which the headline inflation came out actually quite a bit from 6 to 5%. But as a reminder, the Fed target is 2%. So we're still very far from it. But it was a really welcome news, except that the core inflation, so that's inflation excluding volatile prices of food and energy, actually ticked up. So instead of going the right way, went the wrong way, went to 5.6. Again, that's still very, very far from the 2% target. And it tells you that prices are being stubborn in certain pockets of the economy. Most of them are actually, like, for example, housing, rents as an example. But food is still very expensive. Prices are still going up a lot. And even wages that have come down, they're still in the 4.5-ish%. So what we see here is like still a lot of pricing pressure. And on the other hand, the job situation is still very strong. So we're still at 3.5% unemployment rate, which is extremely positive or like very, very low. And of course, we hear about all the layoffs, and we expect the unemployment rate to go up. And yet, we still have about 1.7 job openings for every person who's unemployed. So there's still a very strong market in terms of jobs, and there's still a lot of inflation very far from the 2%. So what the Fed voting members are saying is that they still need to raise rates to at least 5%, and above. So right now it's 4.75 to 5, and then they need to stay there for a while. That's not what the market is saying based on these trading of futures. They're thinking that by the time that July comes, we're going to start interest rates being cut. And so there's a disconnect there between what the central bank says and what markets are saying. So the central bank is saying, no, we're going to stay at above 5 for a while. And the markets are saying that we don't believe you. So it will be interesting to see how the rest of the year evolves. And of course, what the impact is going to be on the economy, and whether we'll see a recession towards year end, which is starting to be more of a consensus case that we will see some, light recession, but nonetheless, like towards the year end.
No, great backdrop, and maybe just piggybacking on that with a quick follow-up question for Carla. Just so, given this macro environment, and what, in your opinion, has been the impact on cost of capital and valuations overall, and referring to both the public company valuations as well as maybe the private companies?
Sure. I mean, that's a great question. So obviously, cost of capital is very tied to where the interest rate levels are. And, to distinguish a little bit, what the Fed is doing, they're working on their policy rate, which is a short-term rate. Whereas for cost of capital, we care about long-term rates because aside from bankruptcy situations, we assume that a business, is going to be in operations into perpetuity. So we want to look at long-term rates, and long-term rates, have risen significantly to the levels we were seeing back just after the aftermath of the global financial crisis of 08-09. So we're seeing them not quite at that level, but we're seeing them around 2010, 2011. There was a little bit of, uptick during market dislocations. So we saw it last fall when, believe it or not, when the UK had announced a budget to cut taxes, and that was really not well received by the market, and that had spillover effects to the US, and so rates actually really went up above 4% even though on the long run, but right now they're in the 3. A 10-year yield is it varies every day. There's been a lot of volatility, but around 3.6 to 3.8, somewhere in that category. So it's clearly higher than what it used to be. And companies that are trying to finance their operations are, of course, now live in a situation where cost of capital, that's on the debt side, but that, I'll speak about the equity side in just a second. Obviously, it's more expensive. It's more expensive to finance operations. It's more expensive to do CapEx. It's more expensive to, embark on acquisition activity. So if you if you were lucky that you secured debt before this rate rise, then you stay put, right? Because you have the below market rate debt, but otherwise it's getting a lot harder. And of course, with the banking crisis, the lending standards are tightening, and so it's going to be harder to. And we've seen that there's a lot less activity on the issuance side right now. So cost of debt on that side definitely higher. The equity side also went up, and what does that mean? It means that when you have more uncertainty around what's going to happen to the economy, there's more variability around your cash flows. And that means that equity risk goes up. And so that's what happened starting with 2022. Until then, the central banks were saying, inflation is transitory in nature. This is just a base effect from the pandemic. It's going to go away and we'll be back to normal. But it turns out that prices were for a variety of reasons, the pandemic, supply chain, and China zero COVID policy, and a number of other things led to a really high inflation that turns out that it's not transitory and it's a global phenomenon. It's not just the U.S. And so what markets started, and then of course the February invasion of Ukraine by Russia exacerbated the issues. So what we saw was suddenly a decline in valuations in the marketplace. So the public valuations very quickly. So tech companies, because Karan, you say you're in the tech space. So the Nasdaq declined by 40%. I mean, sorry, by 30%, over 30% in 2022, and the S&P about 20%. There has been some recovery from the lows in October. So, the markets are tittering. They're okay, there's some good news. I think we were oversold last year, so they're trying to recover, and we're seeing the S&P at around 7% increase since the beginning of the year, but a lot of it is actually driven by mega caps. So there's still a lot of companies that are hurting, and their valuations are really low. What we saw on the private space is that there's a lag. So there's a little bit more of a reluctance or delay in adjusting valuations downwards for the current market conditions. And so even though we saw declines in those valuations, it's not as acute as we saw in the public market space. So going forward, I think that the markets are grasping for positive news and trying to see if there's pockets where they can increase those valuations. But there's still, this year is going to be of a lot of uncertainty still. of what's going to happen and whether there's going to be soft landing or not, and if there's going to be any additional pockets of sectors that have crisis because of the high interest rates. So all of that is still a lot of uncertainty from a macroeconomic standpoint.
Perfect. No, that is an excellent backdrop for the rest of our conversation, and maybe just honing in on specifically the public markets. As Carla noted, public company valuations declined significantly in 2022. And certain sectors like tech, where I'm focused, were most impacted. And specifically, if you look at software, software businesses overall traded down 50%, and certain subsectors traded down even more. So maybe with that backdrop, a question for Doug. Doug, given this market environment, what has been the impact on pre-IPO companies and the financing options available to them?
Yeah, it's a great question, and one that we it's a tale of multiple environments right now. I think for late stage private companies, ones that were thinking about going public, either didn't quite make the window before or looking to go public soon, they're in trouble if they don't have a cash runway through 2024 or beyond, right? Those companies are struggling right now. A number of them took in money during the pandemic and positioned themselves well for the future, but a number of others haven't. And so I think if you didn't, you're worried right now. We're seeing some companies winding down. This is kind of particularly on the life sciences space, right? Where the drug product or candidate didn't work, and there's just no prospect for doing something different, so starting to wind down. Some are getting bridge financing. I think that's available, from in some instances. Down rounds are out there. I think we're seeing some of those. My personal view is we're going to see more of those this year, certainly more than we've seen historically or based on recent history, but there are going to be down rounds. Venture debt remains an option, but that market's in a weird spot without SVB kind of leading things. So I think companies are taking a hard look at their options right now, trying to figure out, what should we do? The capital markets remain closed. The expectation is they're probably not going to reopen this year. If it is, it would be late in the year, for a 2024 IPO. So there's a lot of uncertainty there. But yet, I read yesterday, VC investments were sort of consistent or even higher than historical averages, for the first quarter. Certainly nothing like recent quarters, 2021, 2022. But there is money out there. It's just a little bit harder to find right now. And companies are being very intentional with their cash.
No, I think maybe picking up on one of the topics, with these declines in valuations of public companies, one area of opportunity we've seen is an uptick in take privates. Can you maybe speak to the dynamic there and what you're seeing in terms of an increase in take privates, and what are the dynamics with shareholder activism with a take private situation, and maybe more importantly for the audience here, what are the opportunities for private equity investors, specifically with taking some undervalued public companies private?
Yeah, I think it's a great question. We've talked for many years about the amount of dry powder at private equity firms, right? And that certainly remains true, if not growing, right, every year. So there are private equity firms that are out there, that are active, that are looking for opportunities. We're approaching a really interesting point in the market right now, in that the 52-week highs for most companies are starting to roll off, right? So if you sit there and you look at your Yahoo Finance page, you're not seeing a really high 52-week high number anymore. You're seeing one that's sort of come back down with the overall reset in valuation. So I think that's caused some people to kind of think about things a little bit differently. The 52-week high doesn't necessarily mean anything, but it's a psychological number, right? And you think about, do I want to do a deal? Where do I want to do a deal relative to that? I think it can be kind of hard for a management team or a board to embrace something that's way below that number. So I think private equity is going to continue to be opportunistic. There are a lot of companies that are out there where valuations have come way down. Things are much more affordable now. There are a lot of really good, high quality companies that are suddenly affordable. I'm sure you're seeing that in your practice too. where, great, wonderful names that, would have never been available to private equity in the past because the multiples were just too high are now suddenly affordable, suddenly within the target zone. And so I think there's a lot of excitement over that on the private equity side. Companies continue to see private equity as a way to exit the public markets, retool, refocus with the expectation of coming out again in a few years, right? Continued business model transitions, continued things that might be easier to do outside of the public eye. Those are always going to be good private equity targets and stories. And I think a lot of boards have come to accept that valuation reset is probably permanent, right? I think 6 months ago, a lot of people would have said, well, maybe it'll come back. I don't want to sell out too cheaply. I'm not sure where the market's going to go. I think there's much more realization now that, things are different permanently, maybe, right? Or for some number of years. And we got to deal with the new reality. I also think there are some number of boards and management teams that, quite frankly, are tired after the past few years. It's been a grind. To be a public company in the pandemic, it's been hard to do that. If you're looking at a significant restructuring of the company or maybe exiting product lines or having to do a significant layoff, I am seeing boards and management teams saying, I'm okay with turning over the keys to somebody else and seeing what they can do with the asset, right? I think the challenge there, and we've seen it in a couple of deals recently, is there's a narrative that boards may be selling out too early, right? Allowing private equity to capture all of the value that's going to be created over the next couple of years, right? And I know a number of investors say, well, you should just remain public. Let me, who's been supporting you for a long time, ride along with you and capture some of that value too, right? Don't just give it all to the private equity firm that you want to sell out to. So that's something boards and management teams want to think about. I am seeing a lot more partnering from private equity firms in order to de-risk transactions, particularly with limited partners, co-investors that they know very well. I think there's a lot of that right now. A lot of all equity deals to put the debt in place later, so you bring in more co-investors now. That is, for me, seeing a lot of lengthening of due diligence cycles, right? Because I think in the past, you might just rely on the diligence conducted by the lead firm. I think now, in the current environment, people are saying, no, I want to do the diligence myself, right? I want to get in there and look at all the documents and see everything. So I think that's causing a little friction in the system. In terms of activism, I mentioned the kind of deal-related activism, right, of people opposing deals. I think we'll continue to see that. I think it's been overall a little bit less active of an activism year than a lot of people anticipated. I think that's primarily due to the fact that it's just a really hard market to invest in, right? If you want to make a big bet on a public company, you got to have a really high level of conviction right now if you're an activist fund, because there may be structural things in there or market things where you're never going to be able to get the pop and the price that you're looking for, right? So I think that's made it's caused a lot of activists to sort of sit on the sidelines a little bit. And not take huge positions and not run a lot of proxy fights or campaigns. And that always is helpful to overall M&A activity, right? People pushing for outcomes. So I think it's a really interesting market, a lot of interesting things going on right now on the
very interesting dynamics. So there's actually a question from the audience here that just specifically on the topic of take privates. You talked about de-risking with multiple acquirers, but the question from the audience is, how should a private equity buyer or a consortium protect against class action shareholder lawsuits in the event of take privates? Is there sort of a playbook you recommend?
Yeah, it's a great question. There's no way to inoculate yourself from it, right? I think the statistics are, 95, 99% of deals have some type of lawsuit on them. I think the important thing that you can do as a private equity firm is make sure the process is good, right? Make sure that the company's doing all the things that it needs to do, that the board's been active and engaged, that they spent a lot of time thinking about things. And then you want to be sure that the proxy statement and the disclosures have all material information in them, right? And if you're a private equity fund, you actually want to sit there and look at that pretty carefully and make sure it lines up with your notes and there aren't things in there that are different from your recollection. If they are, raise them, talk about it with the company. make sure it gets all out there. So there's no way to prevent class action lawsuits, and it's sort of just a deal tax, right? They're generally settled pretty quickly. It's a rare transaction. It would have to have really unique and bad facts that it would be held up with litigation. So unfortunately, it's just, as I say, a bit of a deal tax. But process is what's critical to that. Making sure the process is good, making sure that the board has dotted all the I's and crossed all the T's, I think it's something that you want to focus on.
Perfect. So maybe switching gears and stepping away from the public markets to M&A deal dynamics and private company dynamics valuation. So, as Carla mentioned earlier, private companies have certainly seen a derivative impact. It sort of lags and isn't as much in real time. But recently we've seen several large, unicorn and even larger than multi-billion-dollar plus valuation private companies mark down their valuations from the last round. And especially in sort of my world, the middle market M&A world, last year we saw what I'd characterize clearly as a bid-ask spread form in the second half of the year. And it was a function of sellers still having valuation expectations grounded in valuations in 2021, while buyers were very quickly realigning what they were willing to pay. And for a while, it disrupted deals. I think it caused certain deals not to move forward, or deals fall out of bed. But we're sort of seeing this sort of realignment happen as time passes. So maybe, Jeremy, a question for you. Given this bid-ask spread, what have been some of the challenges for private equity firms in getting deals done? And maybe just to piggyback on that as a quick follow-up as well, is just how has the recent banking crisis maybe incrementally impacted PE firms and their portfolio companies?
It's certainly been an interesting market. And I think the private equity market itself has changed dramatically than where it was 6 months ago. So we saw, as you alluded to, in the tail end of last year, the first couple of months of this year, a real decline in private equity deal volume. And a lot of that was driven by capital, the cost of capital being extremely high, that bid-ask spread continuing but starting to narrow, and just a lot of market uncertainty. So we've had some real challenges out there in the market, but the fact of the matter is today, cost of capital is high. There's still, I think the bid-ask spread has come in, but in a lot of deals, there is still there's still a spread. And, although it's getting closer, private equity fundraising is challenging to say the least in the market. But at the end of the day, there's still, I think Doug had said this, there's still a ton of dry powder out there. So private equity firms are motivated to get deals done, but it's certainly transformed what the private equity market looks like. So, 6 months ago, we were still seeing, pretty substantial deal volume. We had a feeling it was going to tail off towards the end of the year, which it did. But I think as we, went through the beginning of this year, went through the banking crisis, depending on who you ask, we may be still in the midst of the banking crisis, and there may be more to come. We'll see. And we're dealing with a lot of market uncertainty. So the private equity firms are having to get creative. And I think what we have seen is, whether you're looking at minority deals where you have management rolling over a considerable portion of their equity, and the private equity firm, where they may have been a majority investor or control investor in the past, being willing to taking a step back. Looking at, as Doug said, co-investments are up significantly. So at the end of the day, the private equity firms are trying to be creative in looking at how do we put our capital to work for the right businesses in a market where the cost of capital is extremely high. At the beginning of the year, I think we definitely saw a decline in quality of deals. And, I spent a lot of my time with the private equity world as well as the investment banking community. And, a lot of the bankers I spoke to, they had deals that, were ready to go back in December, January, even earlier, that they put the brakes on. said, okay, we're gonna put this on hold. We're gonna, let's continue the conversation. Let's continue refining. Let's keep an eye on the markets. Let's keep an eye on the financials. And those deals started to trickle out in kind of the early to mid-March timeframe. So I think what we're seeing now is an increase in quality, increase in quantity, but still weighted by the fact that cost of capital remains high and is likely to get higher depending on who you listen to. So we're seeing creativity, and I think what the banking crisis did is it certainly took one of the biggest venture debt player out of the market. It put some challenges into the credit side, and that coupled with rates and a lot of the big banks still sitting there holding LBO debt on their balance sheets that they hadn't planned on holding. They were looking to syndicate that out. So some of the bigger private equity firms have gotten creative and started buying back their portfolio company debt, either buying it back at the fund level and goosing their returns that way, or buying it back at the portfolio company level, canceling that debt, reducing leverage. We've seen private equity firms doing smaller deals, looking more towards growth equity type deals, and then we've seen a real increase in add-on activity. So when you look at quarter over quarter, the numbers don't look that different in terms of number of deals, volume of deals. But if you take out the mega deals that we saw in the first quarter of this year, the average deal size is definitely down. So part of that is looking at smaller deals, looking at founder-owned businesses, looking at add-ons. But another part of it is that bid-ask spread is starting to narrow, so valuations are coming down. Not necessarily commensurate with what's happened in the public markets, because we're continuing to see some of that lag, but valuations are definitely coming down. And as we talked about, some of those assets that were out there that were almost untouchable by private equity based on valuations, as those numbers have come in, they start looking potentially attractive.
Yeah, no, I think definitely a lot of the points you made resonate, and frankly have been sort of what I've experienced firsthand. Maybe just picking up on a couple of the points. We definitely saw in the software M&A world, we saw a huge decline in deal volume in Q4. In fact, it sort of reverted to levels we hadn't seen since 2017, and it was sort of a sharp decline relative to the prior 9 to 10 quarters. Interestingly, in the first quarter of this year, the deal volume didn't jump. There were some exceptions. Silver Lake's take private Qualtrics, well, $12 billion deal. You take that out, and the actual deal volume in Q1 was very consistent with Q4. That's dollar volume. But interestingly, the number of deals actually ticked back up in Q1 versus Q4 and was sort of not that different from levels in 2021. So I think the takeaway, if you sort of just analyze that, is exactly what we said. You're seeing more deals, but they're smaller deals. You're not seeing as many of the $1 billion plus deals, but you're seeing a lot more sort of mid-market activity come back, but at lower valuations, smaller deal sizes. And then the other point you made, and this is one that's sort of very close to my heart, there definitely is a consistent message I've heard, and you mentioned it, whether I look at our practice or other bankers out there, there's definitely a consensus that there is a large M&A backlog of deals waiting to come to market. And I think there's this general expectation that the second half of 2023 will be much busier from an M&A activity perspective relative to the first half of the year. So maybe just, piggybacking on that, Jeremy, you mentioned it, but just to double click, is your impression that there's an expectation that private equity firms will have an opportunity to put more money to work in the second half of the year, and sort of the M&A environment, the second half of 2023 will be sort of more active and positive than, call it, the first half of 2023?
I think if I say no, I'm going to be getting calls immediately after this from all of my clients saying that's not what we've been talking. Listen, every banker I talk to, every private equity firm I talk to, is thinking the back half of this year. Even my transaction team, the back half of this year, there's going to be an opening of the floodgates. I believe that. I think I'll caveat that comment with, as long as we get some indication and comfort that the Fed is done raising rates, And as long as we have some level of comfort that we're not going to go into a hard landing recession, then I think that will be the case. As soon as we get some stability in the credit markets and understand, okay, we are at a plateau, and we have the Fed is in a restrictive stance as they said they wanted to be, and whether we're at 3%, 4%, 5% from an inflation perspective, as long as the Fed says we're going to hold here, I think that will be enough for everyone to get comfort in, okay, here's where we're locking in rates, here's where we can go to market. And I think at that point, we will see the opening of the floodgates, because there absolutely is a considerable backlog. Just like when you look at the beginning of the COVID pandemic, there was deals were not happening. And what happened is, all those deals built up, and we built up a backlog, and then the floodgates opened. Now, I don't think this is going to be to the same extent of that, but it's still pretty significant. If I look at the just the number of deals that the bankers that I speak to, what they have in their backlog, what the private equity firms know is out there, there's going to be enough to keep a lot of us very busy, for a considerable period of time. The overriding question is, when does that happen? Is that a May? Is that June? Is that July? Is it August? I think there is there will be an opening of the floodgates. There is backlog. Real question is, when does that open? I think based on, depending on what the Fed communicates at the next meeting, and whether they go with a quarter-point raise or if they hold, I think there's going to be some reading of the tea leaves there to really understand. Okay, are we at that point now, or are we a couple or a few months away from that?
Yep. No, and you raise a great point. I mean, this timing question is obviously a really key one. And I think there was sort of a school of thought leading up to March, and then the banking crisis happened. And I think it definitely made a lot of people rethink what was the right time. I mean, again, from a personal perspective, plenty of clients and prospective clients asked the question, starting from the beginning of the year, when's the right time to go to market this year? And I think that hesitation and caution increased significantly with the banking crisis. With the collapse of storied banks, that was sort of unexpected. That definitely changed the dynamic a little bit in terms of people really questioning their theses on when to come to market and when things would recover. So maybe back to Doug, quick question on just maybe that topic of the banking crisis and the impact. Just what, in your opinion, are sort of options available to management teams that are looking to raise capital in this market environment? Just given what we've seen with the banking crisis, and what do you think the options are?
Yeah, I think it's tough to go public right now, right? You're probably not going public in 2023. Just be candid about it, right? So as we mentioned, companies are looking at down rounds. Another option that a number of companies are looking at is reopen the last financing round on the same terms, right? Just taking the money in, similar to what you did before. I think in terms of preserving cash and thinking about, gosh, are there self-help things that I could do? It's looking at streamlining and prioritizing products and pipelines. Public companies have really turned to focus on profitability, so they're pulling a lot of levers to make sure they're focused there. Layoffs are unfortunately very common at tech companies right now. We're also seeing some executives taking reduced salaries, even whole management teams taking reduced salaries. That helps cash, right? Lessens the need for financing. I would say often executives are getting more equity and sort of as the trade for taking less cash up front, right? So there's money out there. We talked about VC investments being actually high relative to historical standards in the last quarter. It's just harder to find. But so I think companies have to put all options on the table right now in terms of how to raise additional money.
Yeah, no, that makes sense. It's sort of pulling out all the stops and being creative. Jeremy's talking about private equity firms being creative. I think you're talking about the sort of management teams and boards and investors having to be creative in the operations and sort of managing of cash. Carla, maybe coming back to you and maybe coming back to some of the sort of macro considerations on cost of capital. just maybe connecting the dots between all the cost of capital considerations we talked about and sort of management teams and CEOs and CFOs thinking about, how to better design their capital structure. What do you think that, how should they think about, changes to their capital structure, or just how to approach sort of analyzing that?
Sure. And I would just like to make a connection first, like to valuation and what Doug was saying, which is, I think companies have to be more realistic about the exuberance that was there in the 2021. So let me give you an example, SPACs, where, I co-author the firm's goodwill impairment study. And one of the trends that I just observed, and I was interviewing with the Wall Street Journal, was precisely that a lot of the acquisitions that were made by SPACs, like those de-SPAC transactions, mergers, the goodwill has been impaired. And what that means is that there was a lot of money paid during these SPAC transactions that is now, like, quote, gone. So a big example would be like, so there's unicorns, there's like Bitcoin type, companies. There's like Aurora as an example of, like, they bought the self-driving business from Uber. And then, a year later, it's all impaired. So I think that companies and boards have to be careful about the valuations. I don't think we're in that, exuberance anymore. And so that is like the starting point. And then in terms of, like, how do you go about financing that? If you're, for example, in a private equity space, you can't use as much debt as you were using before. It's more expensive, of course. And you have to think about the pressure on earnings from this economy that, like, earnings are probably, coming down. I mean, we've seen lots of, like, earnings warnings for 2023 from public companies. And so things that you need to consider is that your debt to equity ratio can't be in the 6-7% anymore. You need to come down with that level. So you need to use less debt. It's harder to use a lot of debt because it's going to be so expensive to raise. So you need to think about using more equity in financing these deals. And so the one thing I would say is that there was a recent report by Moody's, the ratings agency, that said they project default rates to go up above average by the beginning of 2024, like significantly above average. What we had after the pandemic was a Hail Mary. It was like you thought that there was going to be all of this bankruptcy activity and all of these defaults, but that didn't happen. And that was thanks to the intervention of the government, right? With the PPP loans and all of the fiscal, support that was given about, protecting jobs and all of these things. All of that fiscal policy, and along with monetary policy, by bringing rates back to zero and doing a lot of quantitative easing, the impact was that the bankruptcy levels and the default levels were a lot lower than anyone was expecting when the pandemic started. I don't think we're there now. I don't think both from a fiscal and monetary policy. From a monetary policy, you can't afford to, like, lower rates back to zero because of inflation. And from a fiscal policy, there's no fiscal capacity because there was so much debt put in. And so I do tend to agree with what Moody's is saying, is that when they're projecting that a higher level of default rates are going to go up, it makes sense because I don't think you can expect the level of monetary and fiscal support that you had before during the pandemic. And so what that does is that, again, banks are going to be, more reluctant to give out loans, to give credit, even though I'm also seeing stories like Doug was saying that, and Jeremy, that some of the private equity firms are just getting those loans back from banks because they're actually getting them at a discount, and so they can make some, like, return from that, but it's not like new loans. So that's the point. Like, the new loans part is going to be harder, and so you're going to have to do more financing through equity rather than debt in this kind of an environment.
Makes sense. No, definitely makes sense. So, we've covered a broad range of topics. We've talked about the macro environment. We've talked about public markets. We've talked about, the M&A landscape. Maybe bringing it back to just the board level dynamics, and regardless of which type of company you're talking about. I know, Doug, you mentioned the other day that you still see a tale of two boards. Specifically, something I alluded to earlier, which is some boards have adjusted down valuations and expectations, but there are still others holding on to higher valuations and expectations. So the question I have, and open to anyone, Doug or others, how should management teams and board members, and frankly their advisors, help manage these misaligned expectations?
I'll start and then others can jump in. I think it's a lot of communication, right? It's a lot of looking clear-eyed at the future, right? I think if you're a board, you want the management team to come in and say, this is what we think is going to happen this year, and this is what we think is going to happen next year. And I know there's a lot of resistance from management teams right now to doing that, right? A number of them are saying, well, it's just too hard to predict right now. And this environment's too hard. I can't do it. I think if you're a board, to me, that's not an acceptable answer from your management team, right? It's, no, you got to tell me what you think is going to happen. I'm not going to hold you to it and make you say that you're going to guarantee it, right? But you got to have a sense of where you think the business is going and what's happening, right? So it's a lot of conversations like that to try to drive consensus about the next step, the next thing to do. If you're a board and you still believe that you're way undervalued, I don't know that that's bad or wrong. I think it's probably not something you're going to see for a little while, right? You return to the valuations that there were a couple, even a year ago, right? So just being realistic about that and accepting that if you're a public company, you may not entirely control your destiny, right? Somebody else may come in and say, the stock's been way down. You should sell out to somebody else or do something significant, right? Replace the management team or replace a number of directors, because I'm tired of you believing something that's just not being supported by what we're seeing out there in the world.
Got it. So maybe just switching to one of the topics we talked about earlier, again, Jeremy, maybe this is one that I think you referenced earlier, but I think as we're seeing deals get disrupted, one of the dynamics that I've seen in processes is, we're seeing fewer bids in processes than we did in prior to, processes. We're seeing, obviously, there's constraints. The use of leverage is harder, as we've talked about. And also, deals are taking longer to get done. So maybe just a question, again, more tailored to how, both management teams and their advisors should think about, what negotiation strategies are effective in this kind of changing landscape. Take that one, or I'm happy to do two as well.
Sorry, you broke up there at the very end.
Yeah. No,
Yeah.
I just said, yeah. Okay. Do you hear me now? Is that better?
Now we can, yes.
Okay, perfect. No. So Jeremy, I said, I don't know if you want to pick up on answering that question. I can repeat the question. The question didn't come through clearly.
Yeah, no, I think you're talking about the M&A process and kind of what can the sellers and advisors, as well as buyers and the advisors.
Yeah, just in the category of creativity, right? Just how does one get creative, and how do you sort of how do you pick off the nuances there?
Yeah, no, I think it's definitely there's definitely creativity involved, because I think you said it right. Processes are taking longer, and I feel like we've been saying that for a couple of years now, and processes are getting drawn out. We're also, with some of the sell sides we're involved in, as well as some of the buy side work we're doing on behalf of the private equity firms, it's good in the sense that some of the private equity firms we're working with, their hit rate scores. So I think it's really about managing expectations and having open communication around what the expectations are, because where we've seen a lot of these deals fall apart. And I'll exclude the ones that are valuation related, where they've fallen apart, it's really, been about that level of communication between the buyer, the seller, the advisors in the middle. And I'll speak specifically to the private equity deals. That's, where I spend my time with our private equity clients. It's, really, understanding, and, it's been a little, it's a little easier now than it was, 6, 12, 18 months ago, because, we closed that, bid-ask spread. Because there was a challenge before of, every management team came in, and we all felt like they, I was a banker back in the early 2000s, late 90s. Every deal we did, whether it's telecom business, a tech business, all the hockey stick projections. And then it got to the point where coming out of COVID and the year after that, all we saw from these management teams were these hockey stick projections. And the only way to get comfortable was to get creative and craft these earnout structures that no one was happy with at the end of the day, but it was what it took to get the deal done. So I think now, I mentioned a little bit about this before, getting creative in terms of ways to bridge the gap. So you have the conversation, everybody's on board. The seller feels like this private equity buyer is the right buyer because of what they bring to the table. They get creative around the valuation side, and are able to get there with management rolling over equity, and that's them basically putting their money where their mouth is and showing their commitment and buying to the projections without having to go down the earnout path. Looking at the private equity firms are getting creative in terms of how they're they can't put as much debt on these businesses as they could before. And I think it shows in terms of, if you look at past recessions and funds that were put to work or raised and put to work during recessionary periods, firms are going to be a lot more careful in what deals they do if they're putting 60%, 70%, up to 100% equity in a deal versus being able to lever it up 6+ times. So I think we are seeing creativity around, whether it's through co-investment, whether it's management rollovers, looking at different ways to structure and finance these deals. But what it's leading to is deals are taking longer because there's a lot more diligence that's going on. There are a lot more aspects of the business that are being diligenced now than were being diligenced 6 months ago, 2 years ago. So I think it's a combination of all sorts of factors coming into play here, which are some are market driven, but a lot of them are private equity firms in particular are going to be a lot more careful about the deals they do. It doesn't matter if it's an add-on or if it's a new platform, just because there's significantly more risk out there now, particularly if they're putting in way over their typical equity ratio on a deal.
And Jeremy, I mean, I think that's your point about rollover equity is interesting because, I see things from the other side of the spectrum, which is when a company acquires another, there's things like purchase price allocations and all the kinds of valuation needs. And we have been told by people on the ground that they're seeing a lot of rollover equity where the target management rolls over their equity, but it's subordinated to the private equity owner, like the buyer. So there's like some more complexity in those structures that it's no longer just like I get a pro rata share. No, you get a different class of shares, and they're subordinated to the PE owner. And so we're seeing an uptick in those types of deals, or that there's a platform company in the PE space and they're acquiring another one, but again, using the rollover equity with a subordinated component to it, such that the PE firm still has like the say Class A shares, and the management gets like the B shares as an example. So we're seeing a lot of that.
Yeah, I think another one that we haven't necessarily focused on, is not necessarily the topic of this conversation, is the antitrust environment, right? Private equity is very much in the crosshairs in Washington, and there are a number of private equity firms who would like to be doing sort of roll-up strategies built around a platform, right? Traditionally, they would have been able to do that fairly easily. I think that's not the case right now. And so, if you're if you're thinking about rolling up 3 companies, right, and it's going to take a year to get a thumbs up or thumbs down from the government, you may not be pulling the trigger on those deals right now, right? Because, why would you want to wait all that long and all the uncertainty and disruption, that sort of thing. So I think that is having, I'm seeing a much bigger impact on the antitrust side on private equity willingness to do deals than I have historically, just given the current environment.
So I know we're sort of approaching the end here, and maybe just to close out, there is a question from the audience, and this could be one we could debate for hours, but would love to get your quick take on it. So one of the questions is, can we compare the current market environment, the current situations to anything we've seen in the past 2 decades? Reference to the dot-com bubble and or the global financial crisis in '08. And really, I guess maybe I'll sort of tailor it more specifically to keep it focused. Are there any lessons learned that we can apply today that would be helpful, call it, for the rest of 2023 and 24? And anyone on the panel, feel free to pick it up.
Well, I do think that the situation is not as bad as in 2008. There's more regulation, for example, in terms of banks, because it really was like the banking crisis, in steroids. And I think that is not what we're living here. Banks are a lot more well capitalized. And so we're not going to see that kind of crisis. That doesn't mean, and that's normal in any recession or leading up to a recession, that lending standards get tightened. That's just normal, and so that's what we're seeing, right? That the lending standards will probably continue like this for the foreseeable future, and that's going to have an impact on, as we talked about, on the M&A activity and how it's financed.
Perfect. So, well, thank you, everyone. It's been a very sort of productive, interesting dialogue, and I'm sure we'll have many more of these discussions over the course of the rest of this year as the dynamics continue to evolve. Thank you for your time. As I'd mentioned, we'll have a recording of this webcast available, and to the extent we didn't answer your questions, we'll reach back out. But thank you for your time, and thank you to the panel, and look forward to chatting with everyone in different forums.